It beat. It raised the year. It fell 9%. On the 20th of August, the biggest retailer on earth reported its quarter. It made more money than Wall Street asked for. It then raised its forecast for the whole year, and by the closing bell, it had lost about $83 billion of value. That is its worst day in 4 years. So I opened the filing, and the beat is real. Every number in it is real. There's just a piece nobody put in the headline, and it changes what the whole quarter means. Earlier this year, the courts threw out a set of American import taxes. The government started sending the money back. Walmart's share came to about $2.9 billion, and almost all of it landed in this one quarter. Now, most companies will keep a windfall like that. Walmart spent it. It cut the price on about 11,000 things on its shelves, which is either the smartest thing it did all year or the most expensive. By the end of this, 5 models will each put a price on this company. The cheapest and the dearest are more than 4 times apart. Then we run 10,000 simulated futures and see how many of them land above today. Stay to the end for the number.
Start with the number the headlines used. Profit came in at 81 cents a share. Analysts had asked for about 74. Sales came to about $188 billion for the 3 months. That is up almost 6% on last year, so more money went through the tills. The online business grew 23%. The advertising arm, which sells space on its own website, grew 38%. Those are the parts the bulls point at, and honestly, they are growing beautifully. And the stock fell 9% anyway, so something in that quarter frightened people more than the good parts reassured them. Go back to the refund. For 2 years, American importers paid emergency taxes on goods arriving from abroad. The courts ruled those taxes unlawful, so the money went back. Nobody imports more into America than this company. Its refund came to about $2.9 billion. The finance chief said that money added roughly 7.5 percentage points to the quarter's profit growth. Now here is where it gets uncomfortable. Retailers live and die by one number, comparable sales. That just means takings from shops already open a year ago, so opening new ones cannot flatter it. In America, comparable sales grew 2.6%. That is the shops already open, against about 3.7% Wall Street had penciled in. It is the slowest that number has been since 2020. The number of shopping trips grew 1.5%. 3 months earlier, it had been about 3, so half the traffic growth just quietly went away. So the company did the thing it has done since 1962. It cut prices, 11,000 items up from about 7,000 3 months earlier. And then it did something that looked, on the surface, very confident. It raised its guidance. Guidance is just the company's own forecast for the rest of its financial year. It lifted the top end of that forecast. Then it said what to expect from the next 3 months, 62 to 64 cents a share. Wall Street had wanted about 68, and the finance chief explained why in the most honest sentence in the release. The price cuts landed at the very end of the quarter, so the full cost of them shows up in the next one. So the refund is real, the beat is real, and the cost of both arrives later, which means the argument was never really about this quarter. It was about the multiple. That is how many years of a company's profit you agree to pay for one share. The price is a bet on the multiple. Hold on to that sentence because everything from here explains it. There are 5 ways to price this company, and all 5 are public. 2 come from the banks. 2 come from investors who are dead and still right. 1 is a machine. The first model treats a company as a machine that prints money. How much will it print, for how long, and what would you pay today to own it? Every number we feed it is the company's own. We take its forecast profit for this year. We grow it at the rate the company itself just promised, about 7.75% a year. Then we ask what the machine is worth at the end. And that model says $98 a share. That is about 6% under where the stock trades. So on its own numbers, priced its own way, this thing is close to fair. Except that answer hides an assumption, and it is the biggest one here. The multiple again, that price you agree to pay for each year of profit. Over 10 years, this company has traded at about 31.5 times its profit on average. That average is what the cash machine just assumed it keeps forever. Change that one input and the answer moves further than anything else can move it. So the second bank model assumes nothing. It looks at what the shops next door cost. We took the 5 retailers this company actually competes with and priced each one this morning. And before that number lands, hold this. On the morning after the fall, 13 separate firms cut their price target on this stock. Not one of them cut its rating. Every single one still says buy. Keep that in your pocket for the verdict. The middle of that group of 5 is priced at about 20 times next year's profit. This company is priced at 37. Put the neighbor's price on this company's earnings and you get $57 a share. So 2 serious models fed the same company on the same morning are $41 apart. One assumed it keeps the price the market has always given it. The other assumed it gets what its neighbors get. The price is a bet on the multiple. Now the investors. Benjamin Graham taught Warren Buffett, and in 1949 he wrote down a ceiling. Never pay more than about 15 years of profit for a share, ever. Apply that ceiling here and you get $42 a share, which sounds absurd, and it is worth saying why. Graham was pricing factories in a world with no computers. His rule calls almost every modern giant expensive. But he earns his place. Graham's rule works as a question. It asks what you are actually handed for your money. And here you are handed a company that keeps about 4 cents of every dollar crossing the till. Peter Lynch ran the best fund in America for 13 years, and his rule is simpler still. A fair price is roughly the growth rate. Grow profit 10% a year and 10 years of profit is fair. This company just told us it expects to grow profit under 8%. Lynch's rule gives it 8 years of profit, and that comes out at $22 a share. It is the lowest rung on the board by a distance. So 4 models are in. $22, $42, $57, $98. Same company, same morning, same public numbers, and the spread is more than 4 to 1. So let's turn the question around, which is the move that actually settles arguments. Instead of asking what it's worth, ask what today's price already assumes. Run the cash machine backwards and the answer is clean. Today's price assumes this company keeps a multiple of just under 34 times profit. Its 10-year average is 31.5, so the price isn't asking for a miracle. It is asking for the thing this company has had for a decade and then a little more. That is a much more interesting bet than it first looked. Which brings us to the machine. Every model so far picked one future and priced it. One future is a guess, however careful, so we stop guessing. Instead of predicting one future, the machine rolls the dice on 10,000 of them. Some futures where the shopper keeps spending, some where the price cuts never earn their money back, and some where the market decides a grocer is just a grocer. Every roll prices the stock. Stack 10,000 answers and you don't get a guess anymore, you get the shape of the future. And these are the dice named, where full-year profit lands inside the company's own forecast, how fast it grows, what the market pays for $1 of that profit, what borrowing costs, and one more which matters most. The refund does not come again. In a third of these futures, the price cuts it paid for never bring back enough shoppers to cover them. That die is in the box and it is labeled. Here is what 10,000 futures look like. The middle one lands at $93. 9 in 10 land somewhere between 56 and 136. And 34% of them finish above where the stock closed on the day it fell. Read that honestly and it cuts both ways. 2 futures out of 3 finish below today, but the spread is enormous and the fat part of it sits close to the price. The machine calls this company dear and it calls it durable. So what would actually move that? We tested each input on its own, holding the rest still. One of them dwarfs everything. The shopper matters, interest rates matter, but move the multiple from 15 years of profit to 42, and the answer swings further than the other 2 combined. Quick, honest ask. This show is brand new, and every one of these models takes days to build. If you want to see the next stock on this table, the subscribe button is how you vote. It genuinely decides whether this series continues. One more thing before the verdict, and it carries a warning label. This is a stress test and it is not a prediction. We borrow the worst falls this kind of company has taken before and ask where the maths would land. A normal cooling of the multiple takes it to $91. Slipping back to the multiple it has averaged for 10 years takes it to 87. A hard break in consumer spending, 69. And the 2008 path where credit tightens and the shopper disappears at once, 57. Then there is the floor, take the bottom of the company's own forecast, cut it a further tenth and price it at 18 years of profit. That still leaves a premium because a shopper's default habit is worth paying for. It gives you $45. And notice what just happened. The panic maths and the earnings maths disagree by a lot. That gap is exactly where the money moved last time. And let me put the other side properly because it deserves it. This company has raised its dividend every year for 53 years running. Its online arm grows at 23%, its advertising arm at 38%. If those keep compounding, the multiple is arithmetic about a different business.
So here's the whole board. Lynch says $22, Graham says $42. The shop next door says $57. 10,000 futures say $93. And the cash machine, running on this company's own promise, says $98. Stack the fair value votes, and the middle of them lands at $75. The stock closed at $103.84 on the day it fell. So the models say this one is overvalued by about 28%. Now put that next to Wall Street. After all 13 of those cuts, the average target across 43 analysts is still $129. That is a long way above our board. They are not reading different numbers, they are paying a different multiple. So what would flip me? One number and I'll name it. Today's price assumes this company holds just under 34 years of profit per share. Its 10-year average is 31.5. If it holds that, the board is nearly right where it is. If the market ever decides a grocer is just a grocer, there is a long way down and nothing in the earnings stops it. And I want to be fair to what actually happened here. The company got $2.9 billion back and handed most of it to its shoppers. In a year when food prices hurt, that is a defensible thing to do. The market punished it for exactly that, which tells you who the market thinks it works for. If you take one thing from this, take this. Not the shelves, not the refund, not the quarter everybody spent the morning arguing about. The price is a bet on the multiple. Which stock should go on this table next? Tell me in the comments and I'll build it. None of this is financial advice. These are deep models built on public numbers. And every model on this board has been wrong before. That is exactly why we run all of them.